In April 2010, an explosion on BP's Deepwater Horizon drilling rig in the Gulf of Mexico killed 11 workers and triggered an uncontrolled oil spill. Within hours, the rig sank, and the well beneath it began releasing oil with no immediate way to stop it. What started as an operational failure quickly turned into a financial crisis as the scale of the spill became clear. Millions of barrels of oil continued to flow into the ocean, and each passing day increased the cost of containment and cleanup. BP's stock price dropped sharply as investors reacted to the growing uncertainty and potential liability. Early estimates of the damage proved inaccurate as the spill continued far longer than expected. At this point, the situation had already crossed a threshold where containment alone could not limit the financial impact. Government pressure intensified, and legal exposure began expanding beyond initial projections. What followed was not just an environmental disaster, but a cascading financial burden that would cost BP tens of billions and reshape its entire structure. By 2010, BP was one of the largest oil companies in the world, operating across exploration, production, and refining at a global scale. Its growth depended heavily on accessing difficult reserves, including deep-water drilling in the Gulf of Mexico. These projects offered high returns but required complex engineering and strict operational control to manage risk. To remain competitive, BP focused on efficiency, cost control, and faster project execution across its operations. Deepwater Horizon was part of this strategy, drilling in extreme conditions thousands of feet below the ocean's surface. At that depth, any failure would be difficult to contain, making prevention the only reliable control. Operations continued under tight timelines, with multiple contractors involved in the drilling process. By the time drilling reached its final stages, the system was already under pressure to complete the well without delay. As the well approached completion, critical decisions were made to keep the project on schedule and within budget. Warning signs began to appear during pressure tests, indicating the well was not fully stable. Instead of stopping operations, these signals were interpreted as manageable, allowing work to continue. Key safety barriers that were designed to prevent a blowout were either reduced or not fully verified. This created a situation where multiple layers of protection were weaker than intended. At this point, the system still appeared functional, but the margin for error had already narrowed significantly. The operation depended on the assumption that nothing would go wrong in the final stages. By continuing forward under these conditions, the risk was no longer theoretical. It was already embedded in the system. Late on April 20th, 2010, pressure surged unexpectedly inside the well, signaling a loss of control deep below the rig. Gas forced its way up through the drilling system, bypassing weakened safety barriers that were meant to contain it. Within minutes, the rig was overwhelmed as flammable gas reached the surface and ignited. A massive explosion followed, instantly turning an operational risk into a catastrophic failure. Crew members had little time to respond, as systems designed to shut down the well did not activate in time. The blowout preventer, the final safeguard, failed to seal the well under extreme conditions. At that moment, control of the well was lost, and there was no immediate method to stop the flow from the seabed. What appeared to be a contained drilling operation had already crossed into an uncontrolled disaster with no quick recovery path. In the days that followed, the well continued releasing oil into the Gulf with no effective containment in place. Initial attempts to cap the leak failed, as the pressure and depth made intervention extremely difficult. Each failed solution extended the duration of the spill, increasing both environmental damage and financial exposure. Public attention intensified as images of the spreading oil reached global audiences, amplifying pressure on BP. Regulators and government agencies began demanding accountability, expanding the scope of the crisis beyond operations. BP's share price continued to decline as uncertainty grew around the total scale of liability. At this stage, the cost was no longer limited to cleanup. It included fines, compensation, and long-term legal exposure. What had started as a single operational failure was now escalating into a systemic financial crisis for the company. As the spill continued for weeks, the financial impact began accelerating beyond initial projections. Containment costs increased daily, while cleanup operations expanded across a growing area of the Gulf. At the same time, claims from affected industries, including fishing and tourism, started to accumulate rapidly. BP faced mounting legal exposure as multiple lawsuits were filed across different jurisdictions. Regulatory penalties were also being considered, with potential fines linked directly to the volume of oil released. To maintain liquidity, the company began preparing for asset sales and cost reductions across its global operations. Dividend payments were suspended, signaling the severity of the financial strain to investors. By this point, the company was no longer managing an incident, it was absorbing a financial shock that continued to grow each day. As liabilities expanded, BP's total exposure grew into tens of billions, combining cleanup, compensation, and regulatory penalties. The company was required to establish a multi-billion-dollar compensation fund, committing capital before final costs were even known. Cash flow pressure increased as ongoing operations had to support both normal business activity and escalating spill-related expenses. To stabilize its financial position, BP began selling major assets, reducing its global footprint to generate liquidity. At the same time, credit ratings came under pressure, increasing the cost of borrowing and limiting financial flexibility. The prolonged duration of the spill ensured that costs accumulated over months rather than days. By the time the well was finally sealed, the financial damage had already extended far beyond initial expectations. What failed operationally had now translated into a sustained financial restructuring driven by liability and cash constraints. By the end of the crisis, BP's total financial impact exceeded $60 billion, making it one of the most expensive corporate disasters in history. The company completed large-scale asset sales to fund liabilities, permanently reducing its size and operational scope. Legal settlements continued for years, extending the financial consequences well beyond the initial event. BP's market value had fallen sharply during the crisis, reflecting long-term investor concern over risk and governance. The company was forced to reset its operational priorities, placing greater emphasis on safety and risk management. What had once been a growth-driven system shifted toward stability and compliance under external pressure. The Deepwater Horizon incident remained a defining event, shaping how large-scale industrial risk is evaluated globally. The financial outcome was not just a cost of failure, but a restructuring of the company's entire operating model.